Welcome back to Frontline Macroanalysis TV. I'm Remmy. Today, a deep, on-the-record analysis of the 2025 escalation between Pakistan and Afghanistan and what it means for global trade, capital flows, supply chains, energy markets, and regional geopolitics. We'll walk through what happened, why it matters beyond the region, and forecast the predictable economic and financial ripples global markets should expect in the weeks and quarters ahead. Let's get into it. First, the facts you need. In October 2025, the long-simmering border tensions erupted into the worst bout of cross-border clashes in years. Airstrikes, ground exchanges, and heavy casualties on both sides. International mediation produced a truce and rapid talks in Doha as both capitals scrambled to reduce the immediate humanitarian toll and prevent wider escalation. These events followed months of proxy violence, mutual accusations of harboring militant groups, and a series of targeted strikes that culminated in this escalation. Notably, the clashes had immediate social and cultural knock-ons. For example, Afghanistan pulled out of a scheduled cricket tri-series in Pakistan after reported civilian casualties, an example of how even soft power ties became casualty of the fighting. Put simply, a political security flare-up converted into kinetic military action, then into diplomatic emergency talks. That is our starting point. Now for the economic mechanics. Immediately, cross-border trade flows were disrupted. Thousands of trucks, small traders, and informal trade networks that run the Pakistan-Afghanistan border were halted when key crossings were sealed or became unsafe. Even modest border closures in this geography cascade quickly: supply disruption for farmers and local manufacturers, interruptions to transit cargo bound for Central Asian markets, and immediate revenue losses for customs and traders dependent on daily flows. Why that matters globally? While Pakistan-Afghanistan bilateral goods are small on global merchandise trade totals, the corridor functions as a vital regional artery, the kind that enables resource movement and cross-border supply chains. When those arteries spasm, companies reroute, insurers declare higher premiums, and regional traders accelerate currency hedging or pull forward shipments. Expect frictional trade costs to spike in the short run. Also important, the conflict undermines confidence in planned infrastructure projects, notably the planned expansion of the China-Pakistan Economic Corridor, CPEC, into Afghanistan. Security risk makes capital more expensive, delays construction schedules, and can deter contractors and lenders, which in turn delays the economic integration that might otherwise help stabilize the region. Investors and Beijing will watch the security to investment signal closely. Markets hate uncertainty. Predictable, immediate market moves include depreciation pressure on the Pakistani Rupee, widening sovereign credit spreads on Pakistan's debt, and weaker domestic equity returns for Pakistani banks, insurers, and logistics firms. Why? Capital flight risk, insurance costs rising, and downgrade risk for sovereign creditworthiness. We've already seen earlier 2025 episodes where instability triggered sharp local market reactions, traders reprice risk fast, and foreign holders of local debt or equity tend to reduce exposure. For Afghanistan, markets are thin and opaque, but any credit instruments linked to Afghanistan's reconstruction or CPEC-linked projects will see higher yield demands and longer financing tenors if lenders perceive heightened country risk. Lenders often require explicit sovereign guarantees or higher risk premia in such circumstances. On global risk sentiment, expect a modest risk-off tilt in regional emerging market assets, EM Asia ex-China, in the immediate aftermath, plus higher volatility in commodities tied to regional trade, not because Pakistan or Afghanistan are major commodity producers, but because uncertainties ripple through regional logistics and investor allocations. Derivative desks will widen bid-ask spreads, and multinational risk committees will rerun scenario stress tests. Let's be specific about supply chains. South Asia's manufacturing and agri-value chains are increasingly interconnected. Key predictable channels of impact. 1. Transit route disruptions. Land routes between Pakistan and Afghanistan serve as overland shortcuts for certain Central Asian flows. Rerouting increases costs and delivery times. Some firms will reroute via Iran or Central Asia, but that adds distance and friction. 2. Logistics insurance and carrier capacity. Freight and logistics providers will reassess route risk and may impose surcharges or reroute cargo, squeezing margins for low-margin trades. 3. Input shortages for border manufacturing hubs. Small factories that rely on cross-border inputs, textiles, simple electronics, food inputs, will face shortages leading to lower output or higher sourcing costs. 4. Investor reallocation. Multinationals reassessing South Asia supply footprints may accelerate diversification to ASEAN or East Africa for some product lines, a slow burn effect that raises structural costs for the region. This pattern mirrors what markets saw during previous regional spills of instability in 2025. Firms don't all move at once, but risk analysis and procurement contracts change quickly, and that's predictable behavior. While Pakistan and Afghanistan are not major global oil or gas producers, the conflict's regional impacts on energy projects, pipelines, electricity interconnections, and BRI-linked projects matter. China's interest in Afghanistan's mineral and resource corridors, plus planned cross-border infrastructure, become more politically and financially fraught. If security risk forces delays to energy transit projects or mining exploration, that reduces near-term foreign direct investment and commodity development flows. Practically, that's not a global energy price shock, but it does shift where regional supply chains source minerals and forces longer-term repricing of projects that were expected to unlock resources for manufacturers supplying the global market. Now the geopolitical economics. China has moved aggressively to anchor its influence through trade and infrastructure, and it has incentives to stabilize the corridor into Afghanistan. But instability increases the cost of that stabilization. Beijing may step up diplomatic mediation, offer increased security assistance tied to projects, or slow project rollout to insulate its contractors. In any scenario, expect China to push for security guarantees or stronger local partners before releasing more capital. That changes the calculus for lenders, insurers, and partner states. Consequence: lenders that were pricing in smoother CPEC expansion will now demand higher returns or stronger guarantees. Western aid budgets could shift, humanitarian assistance may rise, while development lending tied to long-term integration may stall until security improves. That means a near-term tilt in capital flows, more humanitarian short-term aid, less long-term private capital into infrastructure. Two social-economic channels matter a lot for macro outcomes: displacement and remittances. Conflict often produces internal displacement and cross-border refugee flows. That creates immediate humanitarian burden and longer-term fiscal strains for host communities. It also disrupts household incomes in both countries, reducing consumption and increasing poverty, which feeds back into political instability and lowers tax revenues. Remittances, a major income source for many Pakistani households, are sensitive to macro risk. If host country banking or remittance corridors are disrupted, household incomes fall and local consumption weakens. That's a predictable drag on domestic demand and can amplify currency pressure in the short term. Predictable medium-term scenarios and probabilities, 90-day to 18-month outlook. Okay, here's the meat. 3 medium-term scenarios with rough probabilities and predictable economic consequences. Scenario A, contained de-escalation, 40% probability Doha talks hold, localized ceasefire sticks, targeted security operations continue but no major cross-border campaign. Trade resumes gradually. CPEC extension is delayed but not cancelled. Economic impact. Short-term market jitters fade over 3 to 6 months. Sovereign spreads compress somewhat. FDI remains cautious but not extinguished. This is the best outcome for markets and regional trade. Scenario B, low intensity, prolonged instability, 40% probability recurrent skirmishes and a slow security freeze, no full-blown war, but persistent incidents keep borders partially closed and insurers risk flag the region. Economic impact, prolonged higher trade costs, slower CPEC rollouts, persistent rupee weakness and steady pressure on sovereign financing. Investors demand higher yields for Pakistan-Afghanistan-linked projects. This is a slow drag on regional growth and the most financially painful for credit markets. Scenario C, broader escalation and regional spillover, 20% probability fighting expands to include proxy groups or wider state involvement, forcing major transport nodes to shut or draw in external powers. Economic impact, sharp capital flight, severe trade disruption, and reallocation of global supply chain routes away from South Asia. Companies accelerate diversification, and global markets price a higher regional risk premium. This is the tail risk but has outsized global consequences. These probabilities are not predictions. They are risk-weighted scenarios meant to guide policy, investment, and corporate contingency planning. To be done. For policymakers and companies, here are concrete, predictable steps. For governments, regional and international. Prioritize immediate ceasefire and humanitarian corridors to limit human and economic damage. Provide conditional guarantees or blended finance structures for critical projects to keep private investment from fleeing while ensuring strong security and governance safeguards. Accelerate trade facilitation in safer alternative corridors to preserve commerce for vulnerable populations and businesses. For companies and investors. Rerun supply chain stress tests for South Asia exposures and price in higher transit and insurance costs. Consider temporary sourcing shifts to ASEAN or East Africa for critical inputs. Hedge currency and counterparty risk aggressively for short-term contracts. Expect local FX volatility. For banks and insurers, tighten underwriting for project finance tied to Afghan integration until baseline security assurances are demonstrated. Price in higher default probabilities. These are not novel ideas. They are predictable risk management moves we've seen in past regional crises. The cost of acting early is usually lower than the cost of reacting after capital has fled. Final takeaways. The 2025 Pakistan-Afghanistan clashes are not just a local security story, they are a live stress test for regional trade networks, infrastructure financing, and the political economy of integration projects like CPEC. Markets will react to headlines now. The deeper effects, rerouted supply chains, deferred infrastructure investment, and altered investor risk premia, will play out over months and years. If you're an investor, a policymaker, or a business leader with interests in South Asia, the predictable imperative is to price in higher security-related costs, design contingency supply options, and push for diplomatic solutions that restore the predictability necessary for investment. That's it for this deep dive. I'm Remmy, Frontline Macroanalysis TV. If you found this episode useful, subscribe, share, and drop your questions. We'll answer the top ones in our follow-up briefing. Stay alert, stay curious, and see you next time. Down together.